Right now, investment opportunities are going begging across Australia. And that's happening because the media coverage of the housing industry is dreadfully bad, and because most Australians get their information by tuning into mainstream media. That's particularly true of markets in Sydney right now. The key problem is the tendency by economists and media to generalise. They publish a single figure to describe, for example, the whole Sydney property market. Now, the Sydney metropolitan area is a city of 700 suburbs, as diverse as Bondi versus Penrith and Manly versus Campbelltown. To try and to describe the tens of thousands of transactions in these many different markets with a single figure is frankly ludicrous, but that's what they do. And the problem is exacerbated by the reality that different figures are published by different research sources. Some say Sydney prices are down 7%, another says 7%, another says 5%. And the reality is that they're all rubbery figures to a certain extent. At hotspotting, because we examine Sydney suburb by suburb, we know that there are locations where prices remain higher than a year ago, that there is still growth in the Sydney market to be found, and that there are opportunities if you know where to look for them. So how do you make sense of all this? Well, that's what we're here to help you with today. Our guest presenter is Rich Harvey, award-winning buyer's agent from Property Buyer. And few people know the Sydney market as well as Rich does. And we're going to be discussing the topic, what's up and what's down, opportunities you may be missing. We're not just going to look at Sydney, we're also going to touch on Canberra, which is also a market of particular opportunity at the moment. So, Rich, welcome.
Great to be here with you, Terry. Always a pleasure.
Yeah, so as I said in my intro, a whole heap of problems have been created out there by a particular slant in media at the moment, which is accentuating the negative and the extreme and not really giving a balanced and fair and accurate view of what's going on in Sydney or anywhere else in Australia for that matter.
Yeah, that's right. I think it's always great, Terry. I always appreciate your very insightful analysis of media headlines and getting down to the facts. But anyone reading a newspaper or magazine or any online forums at the moment would be quite confused about exactly what's happening. Obviously, there's some generic trends down in both Sydney and Melbourne, but what's the extent of the downturn? And is every suburb the same? There's definitely not. There's some suburbs that are performing, still quite well. Quality properties are still trading quite well. So I think in this webinar, we'd like to drill down into specific regions, also look at specific suburbs, and go from there. So. But I thought, Terry, maybe just by way of background, for a lot of the viewers online, perhaps could I just ask you or I'll just introduce myself and just my background, and then I'll just ask a bit about your background as to where we're coming from as well, if that's okay.
Sure.
Just for those that perhaps have not been on a webinar or seminar with me, my background is as an economist. I've been in business for over 18 years, and we've won a number of awards along the way. I'm also the president of the Buyers Agent Association of Australia, which is a network of qualified exclusive buyers agents. I've been the buyers agents chairman for the Real Estate Institute for almost 11 years, and a member of other key organisations, and also a qualified property investment advisor. And Terry, how long have you been doing analysis of the property market yourself?
A scary long time, Rich. It's approximately 35 years. Actually started out as a newspaper journalist, specialising in editing real estate sections, and evolved out of that into providing research and writing services for the real estate industry. And right. With hotspotting.com.au, which is a website designed to help people identify the future growth areas before prices rise. Been doing that for just on 13 years now.
And, fantastic.
Yeah.
Well, that's great. So looking forward to your insights. So Terry, just to give all the viewers a bit of an overview on what we're going to talk about today, we're going to cover off some information about where auction clearance rates are, and again, look at how much credence we put on those figures, look at where median house prices and unit prices are trending, and ask some really tough questions. Is there really an oversupply, and where is that happening? How do you find recession-proof suburbs, and where are they? What's happening with demographics, and just look at where those opportunities might be in this current market where there's a bit of conjecture about where it's heading. So look, we've got a packed program, get some notes. Also, I just want to mention, we'd love your interaction today. So for any of you out there that likes good information, we're going to have a best question. So whoever asks the best question on the webinar today can win a copy of my book. Normally retails for $29.95. We've also got a discount on the book if you wish to buy it today. It's just got to quote the discount code PROP29 2019 and email that to me. So you're very welcome for that. So we encourage your questions. So look, let's move on to auction clearance rates, Terry. And we see these figures quoted all the time in the media. You know, the auction clearance rate in Melbourne was 61% or whatever. So let's look at the numbers in Sydney for the last weekend. And here's the results. So you can see that there's a really mixed bag of figures there. So there were 315 auctions across Sydney last weekend, and the overall clearance rate was 61.5%. But if you look at places like the Northwest or the Upper North Shore, 75% of auctions had a successful result, whereas areas out in the West or the Southwest only had a 28.6% figure. So how do you make sense of those figures, Terry?
Well, again, it comes down to the remarks I made at the beginning about generalisation, and it's a great illustration of the importance for property investors and other real estate consumers to dig down a little bit deeper behind those generalised figures, because, well, the first thing that strikes me about those figures is that they're surprisingly positive, given the tone of media that we're getting. You know, 62% overall clearance rate is a pretty strong performance in a market that media keeps telling us is in crash mode. But then the lesson is, when you dissect by region, you find that there are locations out there doing 70 and 75% clearance rates at the moment, which means that three quarters of properties that are being offered in those markets, and they include the Inner West and the Northwest and the Upper North Shore, according to those figures, three quarters of them are selling at auction, which is
it's a pretty healthy. It's a pretty healthy market, isn't it?
Well, it's better than healthy, I think. It's just totally contradicts that notion that the market's going through the floor. I think there's no doubt there's been a readjustment in pricing expectations, but nevertheless, properties are still selling at a pretty healthy rate, according to these numbers.
So just have a look, just as an example, Terry, Canterbury Bankstown, we'll keep that region in mind for a later slide about where prices are heading. But compare, so Canterbury Bankstown, which had 25 auctions and a 52% clearance rate, with the Inner West, which had 44 auctions and a 72% clearance rate, or the Upper North Shore with 40 auctions and a 75% clearance rate. So my demonstration of the point here is that quality properties in high demand locations will continue to sell well. They're not perhaps getting the same result price-wise as they were 2 years ago, but they are still trading and there's still strong demand. I mean, I went out to several auctions on the weekend, and some of the properties went just over reserve, some just reached reserve, and there were 4 to 5 bidders active on those properties. I also went to an auction that was for a bit of a lackluster property on a major road, and there was really only 2 bidders on that, and it passed in, didn't even make reserve. So again, it's about the flight to quality in this market. Now, if we also look at the next slide, Terry, about how does it compare across the other capital cities, both last weekend compared to the same time last year. So if we look at Sydney, it almost actually surprisingly had the same result, 61.5%, which is pretty ironic. But look at Melbourne. Last weekend, it was a 51% clearance rate. But at the same time last year, it was a 66% clearance rate. So, the other point to note is that Sydney and Melbourne dominate as auction capitals. Melbourne even is more of an auction city than Sydney as a method of sale. But the other capital cities, again, I don't put too much credence on and weight on the value of auction clearance rates, because the vast majority of sales in those other cities, Brisbane, Adelaide and Canberra, are not done by auction. They're done by private treaty. Any other thoughts on those figures, Terry?
Yeah, I think it's important to put those figures for Brisbane, Adelaide, Canberra into perspective. They're fairly normal clearance rates for those cities. They're not auction-driven cities, and it's quite common for only 40 or 50% of properties offered at auction to actually sell at auction.
That's right.
That's not what drives the markets in those cities. It's really a Sydney and Melbourne story when we're talking about auctions, and it's interesting again to look at those figures for Sydney, compare the most recent figures with the same time last year, and it's pretty much identical. So again, it puts the general theme being portrayed in media into some sort of perspective.
That's right. Yeah. So look, that's auction clearance rates. Let's move on now to median prices and where are prices at right now compared to 12 months ago. So Terry, take us through here, because you've got 5 sets of data here from 5, supposedly reliable sources, but they're all quoting different numbers. What's going on?
Situation normal, Rich. Unfortunately, very confusing for consumers. How do you make sense of it? But the problem is that media tends to quote figures from one source almost exclusively, and happens to be usually the most negative figures out there, and that's why they tend to quote them a lot, I think, because they like the sensational negatives. But we've got figures there from 5 different research sources, all of them big name, reputable, credible sources, but they all produce different numbers. Like Sydney, how much is the Sydney market down? It ranges from 5% to 11%. In Melbourne, the disparity is even more pronounced. CoreLogic says 9%, but there are a number of big name sources like realestate.com.au that says it's only 2%, and the Real Estate Institute of Victoria says it actually rose 1.4% in the last 12 months. They all have different methodologies. They all claim their methodologies are the best, but like I said at the beginning, to a certain degree, it's all dodgy data, because what they're trying to do is the impossible. They're trying to distill all the tens of thousands of transactions in a city as big as Melbourne or as big as Sydney down to a single figure. And when you consider the diversity in the markets across those big and vast metropolitan areas, like in Melbourne, for example, there are still, in the outer ring areas, prices are still rising strongly in those first home buyer areas. The middle ring's holding up quite well, but the top end's fallen a lot. So you've got all these different situations, but they're distilling into a single figure. And that's why you get these contradictory notions, some saying the market's up and some saying the market's down, and some saying it's down a lot, and some saying, particularly in the case of Melbourne, that it's only down quite moderately. So what do people believe, given that media will tend to emphasise the most negative figures that are available, which tend to be CoreLogic figures?
Yeah. I think it's also important to put into context. I mean, even if you look at, say, the top 2 lines, you've got Sydney ranging between a negative 5% to 11%. And for Melbourne, you've got a range of between -2 and -9. So obviously the trend is down, but you've also got to look at that in context. So a lot of home buyers and investors are saying, oh gosh, why would I buy in those markets? But that's come off, that decline, whatever percentage it is, has come off the back of a 5-year very, very, very strong boom. I've never seen a boom last as long or as high as it has. So we've seen prices rise anywhere from 60 to 90% in both those capital cities, and it's just natural that we've got a correctional phase. And next question is, well, how long will that correctional phase last? I didn't actually put the slide in, Terry, but I've actually contacted CoreLogic and got them to sort of track how long it takes from peak to trough, and we are definitely 18 months into our current correctional phase. But I've noticed that the pace of price decline is definitely slowing, and I think the best buying opportunities are kind of now toward the middle of the year, when we've got the headwinds of the election, the federal election, and a New South Wales state election, and there's uncertainty around policy. So that's a time when we find we get the deepest discounts when we're negotiating with clients, just as a side point.
Yeah.
Sorry.
It's interesting that in the past week, the head of one of the biggest real estate groups in the country, the Ray White Group, Brian White, who's been around real estate even longer than you and I, was saying that based on all the information that's coming back from all their offices, that he feels that the trough for Sydney at least is now, and that's sort of based on those quite optimistic, quite bullish auction results that we're seeing in Sydney, and all sorts of other factors. Time will tell, of course, but to me, it's a very, what we're seeing is a very normal situation, because when we go back and examine the figures going back 20 and 30 years, we see that there are peaks and troughs, and a peak is always followed by a correction phase in the major markets, and that's where we're at in Sydney right now, and Melbourne as well. In general terms, and it feels to me like we're kind of pretty close to the bottom of those particular trough correction phases following very long booms. Just another figure that's probably pertinent to the comments you just made, Rich, is that notwithstanding the decline of the past 12 or 18 months. If you look at Sydney values up until the start of February, over 20 years, it's 202% up over 20 years, notwithstanding the decline of the last 12 or 18 months.
Say that number again, Terry. 200 and what percent?
202%.
There
That's
you go. Yeah.
the rise, the average rise in Sydney house values over the last 20 years. Also, it's important to bear in mind that most people, according to the latest research, there was actually some research done by Roy Morgan recently about how long people stay in their homes and how often they relocate, upgrade, downgrade, whatever. And about 60% of people, haven't relocated any time in the last 5 years. 41% on average across the country are living where they've lived for more than 10 years. So most people in Sydney actually have owned for that long. And so in real terms, they're well up on where they were, say, 5 years ago.
There you go. Well, that's
the recent correction.
Yeah, that's a really good point, Terry. So we might just move on now to, Terry, look at the actual median house prices in the various key regions across Sydney. Now, these are the latest figures from Domain. From the December quarter. They'll be updating them at the end of March this year, in the next couple of weeks. But the figures at the end of December show for these numbers. So again, you've got a natural decline, or as you can see, year-on-year change. It ranges from, in the Blue Mountains, it's only gone down 1.8%. But other areas like the south, in the Shire, has gone down 14%. Northern Beaches down 7%. So again, Terry, let's just talk about, again, how accurate median house prices are. So what's really going on with median prices? Because you always talk about the sample size. So just unpack that for us a little bit in terms of how much value we place on a median price change.
You've got to be very careful with median prices, and particularly changes in median prices. Media tends to portray a 10% change in a median price as a 10% change up or down in values, and it really doesn't mean that very often. Median prices are full of all sorts of anomalies, and particularly if the sales sample is small. So what we tend to do at hotspotting is, if we have a suburb or a town where there's fewer than, say, 30 sales in a year, then the median price we regard as unreliable. So we disregard it completely. We don't include it in our analysis because it's too small a sales sample. I mean, ideally for a location, you'd want sort of 50, 100, 200 sales in a year to sort of feel that the anomalies are all smoothed out by sales activity. Because what can happen, particularly when the sales sample is small, is if there's an upmarket project being marketed at the time of the figures, then we're going to have an uplift in the median price, but doesn't mean property values in the areas are rising to that degree. And conversely, if there's a budget project in the market at that time, it will tend to drag down the median price, but it doesn't mean that property values are falling in the area. So there's all sorts of anomalies inherent in median prices, and we get some quite ridiculous things published in media about, particularly about areas where values have risen 45% in the past quarter sometimes. And it's caused by, it's an area where there's only sort of 7 or 8 sales in the year. So the median price is meaningless. What we're looking at on the screen at the moment are quite broad areas. So there's thousands of sales gone into arriving at those medians. So they can be deemed to be a little bit more reliable and accurate. Although, again, if you seek median price for the Blue Mountains from 3 different sources, you're going to get 3 different numbers because their methodologies are different. And they're pouring a whole lot of transactions into a single great big melting pot.
That's right.
The other thing that stands out about those figures is that, again, when you break it down into regions, you're finding some areas that are holding up quite well and others that are falling a lot more. But generally, you have to say that the overall trend is down. And of course, we all know that to be true for Sydney at the moment.
That's right. Look, what we'll do is just have a look at now some specific suburbs, Terry, and just bring up another anomaly, which I think you highlighted in an article recently. So these are some specific suburbs where the median house price has gone down, but the median unit price has risen. So this is a really unusual paradox. So what brought this to light, Terry? What sort of piqued your interest in this? sort of
I
particular
think
phenomenon?
we became aware of this because we do a regular suburb by suburb thing, which is a far more instructive than publishing a single figure for Sydney. We look at it suburb by suburb, as we do for all locations right across Australia every quarter. And what we started to notice was that there was suburb after suburb in Sydney where the median house price was down a lot, but in the same suburb, the median apartment price had risen over 12 months. The suburbs on the screen are a sample of those. There's a lot more with the same trend, many dozens of them. And I think what's happening is that, as far as we're concerned, the reason why the Sydney market hit its peak and started the trend down was because it'd been going for 5 years. Booms don't go on forever, but booms tend to come to a halt because they hit an affordability wall at all sections of the market. And buyers of all sorts start to say, no, I'm just not paying those sorts of prices. So they pull back and prices start to come down a little bit. But it also means that buyers start to target the more affordable products. And that tends to mean, in simple terms, that units and townhouses in any given location are going to be cheaper than houses on land. So I think we're seeing people targeting units and townhouses. Also exacerbated by the fact that we've got a number of cohorts out there that actually prefer apartments, like young adults. Many young adults, the research shows, have a preference for apartments. They're not just buying them because they're cheaper. They actually prefer that style of living in their busy lives where they don't want to be mowing lawns and weeding gardens weekends. We also have downsizers, a lot of downsizer movement in the market, and they're going for those smaller products because they want something low maintenance.
I was just gonna jump in there, Terry, and just mention, I knew you'd come to it, but I think that's one of the other fundamental reasons why you're seeing the particular price points there. I'll just give an example. So two of those suburbs there on the North Shore, Linfield and Roseville. Now, the percentage of unit stock in those suburbs is very, very low. Along the highway, where they've done rezoning of land for R3 and R4 unit blocks, they now build 4 and 5 story unit blocks. There's a lot of downsizers that are selling their home for 2.5 to 3.5 million, are buying an apartment, but they're buying a luxury product close to the station, close to the shops, close to all the amenities, and they're typically, because there's only a small stock of those properties, they're pushing up the prices because there's not a lot of availability. So that's what you tend to find in some of those areas. Not everywhere. I'd say to be the same in places like St Ives or Turramurra and Willoughby, where there's not a great supply of unit stock available for the downsizer market, but they are in very hot demand, and that's where developers are making a good margin as well, where they're able to develop good quality product, and it helps turnover and helps improve the quality of stock in those areas.
Yeah, I think this is a very significant trend, and you're not going to read about it in our major newspapers because they're only interested in the big negatives. But I think this is an important trend for buyers of all sorts to be aware of, and as we've commented, driven by downsizers to a certain degree, young adults. There's also migrants as another big cohort. A lot of people coming to Australia, and a lot of those migrants are coming into Sydney, are coming from places in the world where apartment style living is the norm. European cities, Asian cities, cities where densities are much higher than they are in our Australian cities, and so they're naturally gravitating towards apartment products as well. So there's quite a strong movement towards apartments as opposed to houses, and that's one of the reasons why I think we're seeing the figures that we've got on the screen at the moment.
Okay, excellent, Terry. Well, look, I think we've covered that one well. We'll come back to some more of those points in a minute, but I just want to move on briefly to talk about other sort of factors about where the market's at and are we close to the bottom. So what we're seeing in terms of vendor discounting and days on market, they're two sort of measures to look at whether the market's a buying market or a seller's market. So in Sydney and Melbourne, we are very much in a buyer's market. It's taking longer to sell the home, and also the level of discounting that's required to sell the home has gone up significantly. During the boom times, the days on market was down to like 24 days for Sydney and Melbourne, but that's blowing out to its sort of long-term average around between 50 and 60 days. The other measure that we should be looking at is just the volume of stock on market. And I haven't got that figure, but we're seeing there's a significant number of rise in listings. So because it's taking longer to sell, there's more stock on the market as well. Terry, what we might do now is just start looking at the specific regions around Sydney, and I'll just bring some comments to the table about these areas. We had the median prices in some of these key areas before, but we'll start with the northern beaches. Nice picture there of Manly Beach, and we find that on the northern beaches, we saw that it only had a 7% decline, but there's certainly some areas on the northern beaches where I've seen suburbs go down 15% already. So in my view, it's a really attractive lifestyle area. There's some fantastic schools, great lifestyle. But the areas that are most recession-proof, in my view, on the northern beaches are those that are harbourfront and within 15 k's of the CBD. We're finding that the price points that are in the highest demand on the northern beaches is the sub 1.5 million mark, which is typically growing families and young professionals. There are obviously still a large number of unit developments going up in different areas, but I don't believe there's any danger of oversupply in those markets. Certainly the downsizer market is very strong. Where are potentially opportunities within the northern beaches? Places like French's Forest, where the new hospital has just gone in, become operational. The roadworks are a complete mess at the moment, but when that's finished, and there's a lot of area that's being rezoned around there. But the affordability value in those sort of areas is very strong. Other places like Cromer, Narrowena, areas that are going through a sort of a gentrification. DY is still very dense, but there's certainly some areas that have strong attraction. In terms of types of properties, again, there's a really good mix on the northern beaches. There's some really good new areas. A lot of renovation works are taking place. But I think overall, I think it's a very fairly recession-proof, long-term good investment on the northern beaches, Terry.
Yeah, we've found, again, when we do our suburb-by-suburb analysis in Sydney, there are certain pockets that look really resilient right now, more so than others. And one of those that really stands out for us in that regard has been the northern beaches. There's still suburbs there where median prices are higher than they were 12 months ago. And generally speaking, there's some markets in Sydney that we've classified as decline markets, but none of them on the northern beaches really fit that mould. It's showing itself to be a very resilient market. Right.
Okay. The next area to look at is the Shire, the beautiful Shire, all around Port Hacking and around the beautiful waterways there. We're finding there's an interesting trend, Terry, happening in the Shire. Our expert there, Stuart, is noticing that there's a lot of people from the eastern suburbs and the inner west that are realising just the value proposition of living on the Shire. Again, similar to the northern beaches, really strong lifestyle appeal. The upper end of the market, you can see that around Cronulla Beach there, the upper end of the market, there's some really strong unit sales and housing sales that are going real well. Also around Woolooware, all of the waterfront properties that back onto there. They're very strong. There are also some danger pockets, places like Miranda and Kirrawee, where there's significant unit developments going on. I think there'll be a temporary oversupply in those markets because we're seeing prices come back a little bit there. But we're also seeing in that sort of pocket between around $1 million to 1.5, they're exceptionally good value. We're finding again a lot of the home buyers are picking up some significant value in those areas. Properties around the sort of the 2 million plus mark are actually more resilient because properties at that level are already renovated, and the type of buyer buying those homes, they just want to move in and have nothing to do. So there's still good demand for that kind of product. And as we said, the demographics is really the younger families and the upsizers. And we're seeing a significant proportion of out-of-area buyers coming into the Shire to buy. I'm not sure the exact figure, but some agents are quoting they're seeing 60% of their buyers are coming from out of area. So that's an interesting trend. Your thoughts, Terry, on the Shire?
Look, I don't have much to add to what you've already said. I think you've summarised it pretty well, just reinforcing that relative to prices around Sydney, it does offer good value for money. I think that's a key driving factor, as well as the lifestyle element that you mentioned.
Yeah, and again, not far from the airport too, being on the Sutherland Shire. All right, so the next area to look at, Terry, is the inner west. It's always one of my favourites. People don't realise just how close it is to the CBD. But in the inner west, there's always a lot of properties what I call ripe for renovation. We're seeing people that are perhaps priced out of the eastern suburbs moving to the inner west that are really liking that cafe culture, and a lot of organic-based businesses are moving over there. So again, the inner west is proving very strong. Again, because of the limited development opportunities in the inner west, it's very tightly held. Traffic is always a challenge, but the light rail has certainly made a bit of a difference to sort of values. But we're seeing that market is quite good. Even properties that need major renovations are still in high demand, and we're seeing some dumps still, attracting a large number of buyers. And the inner west buyers are typically very parochial. They certainly love their suburbs and love all the areas around there. Any thoughts on the inner west, Terry?
Yeah, it's the other one that stood out for us as being particularly resilient when we did our most recent suburb by suburb. The two I guess you might say upmarket areas that really stood out as holding with strong demand still and pricing levels pretty resilient were the northern beaches and the inner west.
Yeah, okay. One of the sort of tips for anyone watching, some of the suburbs that I particularly like is Marrickville, Newtown and Enmore. Little Enmore is only a small suburb, but again, it's sort of got that sort of trendy, almost grungy feel. But I really think that's certainly a suburb to be watching going forward in the future. The eastern suburbs, look, that's a great market, always very, very strong. Has come back a bit. Obviously, some of the higher priced properties haven't traded, but there's certain suburbs, Terry, in the east that are just unbelievably strong. Places like Vaucluse, Rose Bay, Darling Point, Potts Point, Point Piper, where there's very low turnover. Your median price in Vaucluse is sort of in the high fours, 4.6 million, I believe. So there's some pretty spectacular sales. So the buyers in those suburbs are not typically buying with bank finance, so they're unaffected by interest rates and by any kind of credit squeeze. They're typically CEOs or company owners, and they operate at a very different level. There's still overseas buyers also trying to buy and still paying the fees and buying into that market. So they're not traditionally affected, as I say, by that market. But in the other sort of, I guess, more affordable suburbs of the east, if you like, Bondi Junction, places on the fringe like Waterloo, Surrey Hills, Redfern, there's still good demand. And we're seeing more first home buyers trying to enter the unit market in plenty of those suburbs. So that's what we're seeing. Because the market's come back, there's a bit better affordability, and there's more activity at that lower end of the market too, Terry.
Yeah. Again, just referring to our exercise, when we look at it suburb by suburb, we found that some of the big name suburbs in this precinct have actually shown significant growth in the last 12 months in terms of their median prices. Vaucluse, its median price in the last 12 months is up 6%, and Bondi Beach is up 17%. So again, it's that contradiction that you find when you actually dig beneath the generalised figures and look what's happening in individual precincts and individual suburbs. You find plenty of suburbs where prices are down, but there's also a surprisingly large number of suburbs where prices are up in terms of the median price, and strong examples of that would be Vaucluse and Bondi Beach in that eastern suburbs area.
Also, the thing to watch, Terry, as I guess not so much a game changer, but a transport changer for the east is the light rail, which is still a bit of a mess and been delayed at least 18 months. But when that's finally operational, they're running test trains at the moment. The commute time from Randwick to the city will be cut down significantly. So it'll make some of those parts of the eastern suburbs from Maroubra, very, very attractive. So watch this space. All right, the next one we've got is the northwest and southwest. Again, quite different markets, but we're seeing again in these areas, I'm not really seeing any evidence of major oversupply. There are quite a lot of greenfield projects, some new house and land packages out like at Oran Park, down in the southwest. But in these well-placed estates, we're seeing good builders are getting some buyers, but they are having to discount a bit. But places like Glenfield, Hoxton Park, West Hoxton, Morningsea Park, and Edmonton Park are doing okay. And properties around Harrington Grove, Mount Annan, and Narellan, they all have strong appeal. And again, they'll be all located quite close to the new Badgerys Creek Airport that's under construction, and also the Southwest Rail Link that's going through. We're seeing that the price points in both the southwest as well and the northwest around that $700,000 to $800,000 mark for a freestanding home is very, very attractive. That seems to be the main price point that people are going for. As for suburbs, perhaps that have the best opportunities or the best value, we're tipping places around sort of Penrith to Blacktown region. Again, anywhere that's going to be within a good proximity, sort of 20 minutes from the new airport, we think will have some good value going forward. So that's what we're seeing. And I think in terms of demographics in these areas, Terry, buying in well-established centres like Blacktown, that's close to the Blacktown CBD, 3-bedroom villas and townhouses along railway corridors are also quite in demand. Any thoughts about the west or the north and southwest, Terry?
Yeah, the one that stands out really is the southwest. In terms of our research, the southwestern areas, the local government areas like Campbelltown and Camden, which offer a higher level of affordability. The figures show that first home buyers are surprisingly active. You know, we keep hearing that young people are priced out of the Sydney market, but the first home buyer numbers in the last 12 or 18 months have actually been very strong in Sydney, and these are the sorts of areas they're targeting because of affordability, and also the amenities are good. So we're seeing suburbs there where demand is still rising and prices are holding up very well. In the Campbelltown, Camden precinct, in particular, Cobbett's probably a typical suburb. Quarter by quarter, the number of sales are still rising, and in the last 12 months, its median price is up 3.5%. So just against the general trend in Sydney and some of those places. And I also agree with your comment about proximity to the airport. I think that is going to be a massive generator. We've already seen it. Probably the biggest value growth that's been seen in Sydney. Lots of Sydney places have had big value growth for 5 years before the recent correction, but probably the precinct that's had the biggest has been land values around, say, within 30 minutes of where the new airport's going. I think that factor is going to continue. Airports are massive generators of all sorts of things, including huge jobs. And those big things are going to spring up around it. People like to buy close to where they're working. So we're going to see a lot of people buying it that way, A, because it's more affordable, and B, because it's going to be close to where they're going to be working, something related to the new airport. So, and lots of infrastructure is going to be built, road links, rail links, all sorts of things. It's going to be a massive generator.
Yeah. Just one point to make, Terry, just about land, just the broad acre land prices, not individual house prices, but broad acre land prices around the airport. A lot of vendors out there are expecting to get, think they've hit the gold mine and waiting for developers to knock on their door, which has been happening. But land prices have come back significantly as well. So there's also been the thing called the SIG, significant infrastructure charge. And that's also imposing a bit of a limit on just how fast land's being developed out there. There's a lot of developers are not touching land out there now because it's just too expensive to develop. So until either the vendors reduce their expectations or the government reduces the amount of overhead that they're going to be charging, I think it'll be a little bit slow in terms of supply.
Yeah. It's one of those classic times in a market cycle where vendor expectations haven't adjusted to the new reality.
That's it.
So there's a bit of a standoff between buyers and sellers. Once that adjustment is made, things will start to move again, no doubt.
That's right. Yeah. All right. Well, look, Terry, let's move on to the next stage of our presentation. Let's look at where's the market going to head. We've looked at some numbers and talked about that, but let's have a look at where we believe the market's going. From my perspective, we are definitely in a buyer's market in Sydney. We're seeing a far more balanced market. It's tipped in favour of the buyers. When you attend an auction, there's less bidders. Like during the boom, you'd have up to 10 bidders bidding for a property. It was a race to exchange. Very difficult time to buy. Whereas now buyers are taking a lot more time. They're being very picky, being much more considered and standoffish. So it's a good time to be actually making offers and seeing what you can actually achieve. We're actually been getting some fantastic results for our clients. I haven't included any case studies in this presentation, but I can do that at another time. But we think the next 3 to 6 months is providing some of the best opportunities to buy. And just because the market's slowing, it doesn't mean from an investment perspective or even a home buying perspective that you necessarily sit on the sidelines. In my view, capital growth will be a bit slower the next 3 years in Sydney, but you can still make money in a declining market by buying a property that needs work, that needs a renovation, where you can add value, and you can create your own capital growth by creating equity in that property. Any of your thoughts about a slowing market, Terry?
Yeah, I think that looking across all the various predictions that have been put out there by analysts of all sorts, the greatest consensus seems to be around the middle of this year we're going to see the market having bottomed and starting to move into the next phase, which is recovery. And that makes a certain amount of sense. I mean, some of the elephants in the room include the upcoming federal election, and that always gives people pause, not necessarily reasonably, but maybe in this case more so because there are allegedly going to be changes affecting property investors if Labor wins. So once that's all out of the way, and for other reasons, we'd expect things to starting to get a little bit more back to normal around the middle of the year. We're also likely to see the situation with finance to ease. It has to, and it already signs that it already is. And some of the major banks have commented that, maybe we got a little bit too conservative and overreacted to the Royal Commission. Banks need to lend to make their multi-billion-dollar profits. They've kind of overcorrected. They realise that, and they're starting to ease off. We're actually seeing in the last few weeks some of the major banks cutting their interest rates for certain products. There was a comment also by the CEO for Westpac that he believes that the greater scrutiny of buyers' expenses has slowed things down a bit, but that's becoming more and more automated, and so it's speeding up, and so that's going to make things easier as well. So a lot of factors suggesting around the middle of the calendar year, we're going to see changes in markets like Sydney and Melbourne.
That's it.
Bearing in mind that there's all sorts of different things happening in other markets around Australia, there's still lots of strong growth markets to be found.
That's it. All right. So I guess one of my key messages, Terry, to a lot of viewers today is don't follow the herd. If you're buying a property, you're not jumping off a cliff. You need to get the right advice and research the data and go against the herd. So let's just have a quick look at sort of where some of the trends are in the future. And it's often been said that demography is destiny. Population analysis identifies not just where the opportunities are now, but where they're going in the future. So it's important to look at that. So here's what a house could cost you in the year 2050. So let's have a look at that. Can you believe that this is based on just typical standard compound growth? As Einstein said, one of the 7 wonders of the world. So if we take a median house price back in July 2016 and apply a 6% growth rate, it's not 10% growth rate, but just a 6% compounding growth rate, Sydney's house price is going to end up at $6.4 million. Melbourne's median house price back in 2016 was $590. We'll end up at just over $6 million. So phenomenal figures. I think about, well, how are my kids going to afford to buy a property? Well, they need to start now is the bottom line, just like you and I did when we were younger, Terry. I think it's important to be very, very much forward and future looking. But again, just look at the disparity between Sydney, Melbourne versus the other capital cities to what they are now and what they'll be in the future. It's quite interesting, isn't it?
Yes, it is. And I remember maybe 20 years ago seeing a similar exercise done, and was suggesting that in some of our cities, the median price would be above or close to $1 million for a typical house. Well, that can't possibly happen. No one can afford that. And 20 years later, of course, cities like Sydney and Melbourne, those sorts of prices have become the norm, and certainly haven't been a deterrent to people buying, because we've just been through 5 years where in those two cities, the two most expensive cities, we've had record turnover. So.
That's right. Interesting. So, yeah. So my advice to anyone watching is don't be don't watch the market slide you by, So talking of that, so let's move now, Terry, to talk about opportunities. Where are the opportunities in this current market? And we've talked a lot about Sydney, but and I think there's definitely good opportunities in Sydney going forward. But let's have a look at where else we could consider. And again, this is not just talking about one other city, but you've mentioned Canberra. There's certainly got some opportunities. So take us through that, Terry.
Yeah, I recently was asked to speak at a seminar in Canberra, and so I did some particular research for that, and just reinforced our view that Canberra right now is one of the strongest real estate economies anywhere in Australia, if not the strongest. When you look at it from various perspectives, the underlying economic data is very strong for Canberra. Highest average incomes, lowest unemployment, very strong population growth, very low vacancies. A very important thing to note is that Canberra doesn't automatically follow Sydney. In fact, usually Canberra's doing something different to Sydney. And on screen, as we've sort of focused on particular years over the last, say, 10 or 15 years, and looking at what Sydney was doing and what Canberra was doing at the same time. And Canberra's always doing something different to Sydney. It's on its own little cycle because property markets, we know, are fundamentally driven by local conditions, the local economy in particular. And so Canberra right now is an opportunity because it's not falling, it's rising. And there's all sorts of reasons why that is happening.
So you've mentioned, obviously, population growth is strong. I think the other thing to look at, Terry, you've got another slide there for unemployment is very low.
Unemployment's always lower in the ACT than anywhere else. They have an unnatural advantage, of course. It's the capital city, driven by the public service, and so the unemployment rate in Canberra is always significantly lower than the average and lower than anywhere else in Australia. And the average income's also the highest in the country.
And the other thing is interesting to look at vacancy rates right around Australia too. So we're seeing that Sydney and Melbourne, Melbourne's still at 1.9, Sydney 3.2, but look at Hobart, there's very, very low vacancy there still, but Canberra at 0.9. So very tight rental market there in some of those cities.
Yeah, and new figures have come out this week and showing that in many of the cases, the vacancy figures are now lower for 5 of the 8 capital cities than we're actually showing on the screen. The new figures have just come out after the slide was written. So the situation has got it even tighter.
There you go.
But it's already tight. We've got 2 capital cities with vacancies below 1%, a couple of others below 2%.
Yeah.
There's now very few that are above that 3% threshold that's generally seen as the benchmark, which means that generally speaking across Australia we don't have an oversupply issue. We have the opposite.
Yes, correct. And that's a really good point to make, Terry. That's really good. So and rental growth, we've seen significant rental growth in that market as well.
Well, Canberra, as a factor of that strong economy, high incomes, low unemployment, and a very tight vacancy rate, we're seeing rents showing very healthy growth in the Canberra market at the moment. That's a factor that media never discusses. They obsess over prices, particularly negative ones, and they ignore other important market indicators, and rentals is that, because what we're seeing at the moment, prices are down in the bigger cities, not showing massive growth in some of the other cities, but rents are actually outperforming. That means yields are improving, and that's an important thing for property investors to note, that yields, generally speaking, are now trending back up.
Yeah,
and that's going to be a factor. It's almost going to render, to a certain extent, whatever a future Labor government might do with negative gearing is going to a certain extent render it irrelevant, because if your yields are strong, negative gearing isn't a factor.
Exactly, that's right. Yeah, so good point. Well, look, I think, Terry, the other opportunities in my mind, not just in Canberra, but in other areas, particularly in Sydney, Newcastle, Brisbane as well, is for home buyers, where they can previously get into suburbs where they were priced out. Some suburbs have come back 100, even 200 grand in terms of their median value. So there's opportunities for home buyers to get back in the market. Upgraders and downsizers, particularly the upgraders, anyone who's looking at upside that's buying a more expensive property, we're finding they're able to get much better value and be able to cherry pick the right property. And I think also for investors, there's a lot of investors have deserted the market because they can't get finance. But as you've said, I think the credit scenario will start to ease at some point this year. And I'd encourage investors to get ahead of the curve, start getting your expenses under control, talk to your broker about getting your finance, and start to capitalise on this market, because we're still regularly buying investment properties for our clients that have got strong yields in Brisbane. As I mentioned before in other webinars, we're buying properties in that 300 to 400 price bracket, adding a granny flat or doing a renovation, and we're getting, gross yields of around 7 to 7.5%. So you're certainly not getting that in Sydney for a property. But having said that, if you do a renovation on a property in Sydney, you can still, and add an extra bedroom or add a flat, you can still get, good quality yields going forward. So I think the opportunities there are strong. What were you going to say, Terry?
Yeah, just a remark you just made, and referring back to the slide you put up on the screen a little earlier about the herd mentality. I think that's the factor that stops people making the best out of property investment, because most people are herd animals and they tend to follow the herd, whereas the people who do really well in property investments are the ones who actually run in the opposite direction to the herd. So right now, investors have withdrawn from markets from Sydney and Melbourne, and they're actually missing the opportunities are there. The people who are successful in any, whether it's share buying or real estate or other forms of investment, are those that buy when others are selling and sell when others are buying. It's the Warren Buffett, one of the 5 richest men in the world. That's his simple philosophy. And the people who do well are those who detach from the herd, run in the opposite direction, and see the opportunities that the others are missing.
That's good. Excellent. All right. Well, I think there you go. You've just taken the next slide away. There's some of the sort of key takeaways that we were trying to, highlight today. That we, another point to make: interest rates. Where are they going? I think they're on hold or actually going to decline this year. If you look at some of the top interest rate predictors, Bill Evans from Westpac reckons there'll be 2 cuts. I think there could be 1 cut this year, but that's whether that has a huge impact on the property market. I doubt it. It'll just help to put a floor in that bottom of the market area. But as I said, opportunities abound in this market, and it's really important to take a long-term perspective. If you're doing that, I bought a number of properties myself during 2009, the GFC. I'm getting geared up to do the same again right now, and because right now there's just opportunities all over the place. And again, Terry, let's just briefly finish on this in our next few minutes. Just talk about how to approach the market. So, we've talked a lot about where the market's at. How do you approach the market? And what we do as buyer's agents for our clients is essentially these 7 steps. And whether you use a buyer's agent or not, you're going to have to do these 7 steps and work out your strategy, what type of strategy is going to work in this market conditions, your price point, your area, and the property type. You need to get some really deep research on those areas, find the properties, evaluate them, work out what they're worth, and then negotiate them. So they're the 7 steps that we take all of our buyers through. We don't miss any of those steps. You don't want to take a shortcut and miss any of them. It's very important that you complete your due diligence and get the right property. So they're the steps that you need to take. We use a number of data sources, including yours, Terry, and it's important to not just rely on one particular data source. As we've talked about, the data can give you a generalized direction of the market, but getting down and dirty at the local coalface, that's what you've got to look at. We look at value more than price, because that's the thing that's going to make you money over time. If you can buy at market value or lower than market value, you're going to do really well and continue to add value. So that's the thing that you need to do in your research. What are our fees? Just as a bit of point of difference, our fees are a fixed fee. We work on a fixed fee basis. It generally works out to around 2% of the purchase price, but for that you get a buyer's agent working with you every step of the way to create a personalised strategy for you, personalised brief. They'll be able to access both on and off market properties. They'll be there working with you each step of the way. So that's how we operate, and we operate right around Australia. We've got a network of buyers agents that we work with and deliver our service with, so we can cover those areas. And we've won a few awards, as you know, Terry. Actually, next week, Terry, I'm up for the National Buyers Agent Award, so hopefully might get another gong to add to the list, which would be amazing. So we'll see how we go.
It'd be nice if you gave someone else a chance. You seem to win it all the time.
So, just for anyone that would like a copy of the book that I've contributed to, The Secrets of Property Millionaires Exposed, I'll be taking the best, whoever's provided the best question tonight on the webinar. I'll be sending you a copy of the book for free. But for others that want to just purchase a copy, you can get a discounted copy of that book. You just got to quote the discount code PROP2019, send us an email, and we'll send you the form for that. So look, Terry, just to wrap up, is there any other sort of key points that you'd like to just to re-emphasise to our viewers tonight?
Yeah, I thought it was significant when one of your most recent slides, the different data sources that you use. I just wonder how many investors out there use any of those data sources. My fear, my suspicion is that the data source that most people use is the daily newspaper, and I think that's the very worst
Exactly.
thing that people can do. I think people should stop reading newspapers. That's the first thing they should do, and then do some real research and start tapping into multiple data sources and getting real information rather than a journalistic slant on the most negative figures that are around at the moment.
That's right. I agree. So yeah, it's important to not just rely on one opinion, and you've got to find experts that you can trust. You know, everyone has a different opinion, and you've got to verify that information. So yeah,
I think a very strong point to make. And if you made it, you could be accused of having a vested interest, but I don't have the vested interest, so I'll make the point. I think it's really important for people to be willing to spend money on expert advice. I think it's a characteristic of the people I know who have been most successful with property investment over time, that have portfolios of 10 or in some cases more than 20 properties. They treat real estate investment as a business, and as a business, they pay for good advice, buyer's agency, research, all sorts of that the individual experts that they need to make informed decisions and maximise what they get out of property investment. Be willing to spend money on good advice. You get a better outcome in the end. A good buyer's agent will cost you a fee, but they can negotiate a price that actually saves you more than the fee. So there's all sorts of reasons why people should be, the smart people are willing to do that.
Thanks, Terry. That's exactly right. I think it's a lot about leverage. You know, if you engage an expert that is absolutely brilliant at what they do, they can get you a much better result than on your own, and help to accelerate and make a wise decision going forward.
Yeah.
So look, I just perhaps we'll wrap it up there, Terry, but just like to say thank you everyone that participated tonight. Please get in contact with myself or Terry if you'd like further information or to engage our services. We really appreciate you spending your valuable time with us this evening, and we look forward to reconnecting with you again very soon. Thanks very much.
And thank you, Rich, for a very informed presentation. It's always great to engage in a discussion like this where we can actually look behind the generalised figures and the media rhetoric and look at what's really going on, and to see that it's a little bit more complex than it's portrayed in media, and that there are opportunities out there if you understand what's truly going on. So thanks for a wonderful presentation and great information.
My pleasure. Always a pleasure, Terry. Thanks again so much.
Okay, and thanks to everybody for listening into this webinar. And if you want to follow up, as I urge you to do, and contact Rich and his team, the contact details are on the screen now. Thanks for participating. Bye for now.